Hello and welcome to our live session today with Peter. So, what's new in the markets today?
Well, we had the release yesterday of the US CPI rates for January. We had some mixed signals here. We had, on the one hand, the month-on-month rate, which accelerated as expected to 0.5%. Now, the year-on-year rate was expected to slow down. It did, but far less than what was expected. It practically ticked down from 6.5% year-on-year to 6.4% year-on-year. Overall, I would say that the release implied that inflationary pressures are still present, and actually inflation is quite persistent in the US economy, which may allow the Fed to maintain its hawkishness, continue its rate hikes, and practically keep rates at a high level for a prolonged period of time. It was characteristic that Fed officials, and including Dallas Fed President Logan, Philadelphia Fed President Harker, and New York Fed President Williams, all three of them made hawkish comments yesterday, underscoring the Fed's intentions for further monetary policy tightening. However, we have to note here that the release as such failed to excite traders, and despite some momentary volatility, overall the market remained relatively unchanged. I would note though that also during today's early European session, we had the release of the UK CPI rates, also for January. In contrast to the US ones, we had a wider deceleration than expected. The headline rate on a year-on-year level slowed down to 10.1% year-on-year, and that tended to weaken the pound. On the other hand, we have to note here that still inflation in the UK is at a double-digit level, which, in our opinion, underscores the cost of living crisis in the UK. Nevertheless, the slowdown may allow BOE to ease on its hawkishness, and I think that was the main element which caused the pound to weaken, especially against the US dollar. Last but not least, I would be also noting the comments which were made by RBA Governor Lowe in Australia. Governor Lowe was at a hearing in the Australian Senate. He defended the rate hikes of the bank and actually maintained a rather hawkish tone. On the other hand, though, we have to note that he received lots and lots of criticism from policymakers, from lawmakers, of Australia, and he might be up against some political pressure here. Nevertheless, for the time being, we see the case for RBA's hawkishness to be maintained, and that could provide some support for the Aussie.
And how about US stock markets?
US stock markets were rather mixed. We had Dow Jones dropping, we had S&P 500 dropping, but Nasdaq was on the rise. So overall, I would note that the earnings releases may have also played some role. I would be noting though here that Coca-Cola had its earning report released yesterday, met the market's expectations, but still the share price declined. I would be highlighting today, we have Cisco, we have Equinix, we have also from the UK side, Barclays, and I would be also noting Glencore. Glencore may be about to release a jumbo profit, and all four of them could be hitting the headlines, as could also AIG. So I would expect, okay, on the one hand, we have some relative hawkishness on behalf of the Fed, which, by the way, I would say that may have been also the main driver behind US dollar strengthening over today's European session. the Europeans woke up and had the first chance to actually make the first reaction after the release of the US CPI rates yesterday, and in conjunction with the hawkish comments of the Fed policymakers, may have pushed the US dollar higher. That should sum it up about it.
How about gold prices?
Gold prices were also relatively mixed. Were dropping during today's European session as a result of the strengthening of the US dollar. I would be noting that gold prices most probably will be maintaining a negative correlation with the USD, so the main element would be the course of the USD as such. I would also be noting, though, US yields. US yields over the past 10 days were on the rise. And should that rise be maintained over the coming days, we may see investors finding a lucrative alternative to gold in US bonds, which may drive gold prices lower.
And what about oil prices?
Oil prices edged lower, just edged lower, nothing much. It was interesting that AP yesterday reported a slight rise of US oil inventories, which may have spurred some worries about demand. Should those demand worries actually intensify, given also the Fed's hawkish talk, we may see oil's price weakening further.
Finally, what's on the calendar for today?
Well, we already mentioned UK CPI rates for January. Right about now, we're getting Eurozone's industrial production for December. I would be highlighting a very busy American session. We get from Canada the house starts. They are for December. For January, we're getting also from Canada the manufacturing sales growth rate. From the US, we highlight definitely the retail sales growth rate. It's for January. It's expected to get out of the negatives from minus 1.1% month on month to plus 1.8% month on month. And that could provide some support for the US dollar. But I would be also noting the New York Fed Manufacturing Index and the US industrial production growth rate. Oil traders may be on the lookout for the EIA crude oil inventories figure. It's on a weekly basis. Should there be a considerable increase of oil inventories reported, that could push oil prices lower. And during tomorrow's Asian session, we're getting from Japan the machinery orders growth rate and the trade data. I think, though, that the highlight of the Asian session tomorrow is going to be Australia's employment data. Therefore, January, the employment change figure is expected to get out of the negatives and rise, and to reach almost 20K. The unemployment rate is expected to remain unchanged at relatively low levels at 3.5%. And should the actual rates and figures meet the respective forecasts, I think we may see the Aussie getting some support, as that would imply practically a relative tightness in the Australian employment market, which may allow RBA to actually proceed with another rate hike and maintain its hawkishness. Mind you that in the last interest rate decision, the bank had highlighted the inflationary pressures as well as the employment market. So practically, should the employment market remain tight, that would be practically a green light from one of the two prerequisites.
Thank you, Peter. Stay tuned for our next live session with Peter.
So welcome to the technical analysis part of the presentation. My name is Peter Youssef, Senior Market Analyst at IronFX. In front of your screens you have the US dollar index. It's the 4-hour time frame chart. Mind you that all charts to be presented are to be of the same time frame unless otherwise stated. Now what we note here is that we had a slight rise of the US dollar, strengthening. It started in the early Asian session and continued up to the early European session. It now seems to be having some hesitation. But overall, I would note that the sideways motion seems to be maintained. And that provides us with the opportunity practically to alter our support and resistance lines. Recalibration seems to be in place. I'm going to be practically readjusting the levels to reflect better the sideways motion. I think that's better. And also definitely the S2 has to go a little bit higher. Let's go hunting for the S3. I think we can find a better level. Something here. This resistance line is very, very clear. Note how it has been able to reverse the upward motion of the dollar. It's as if at this level it hit the ceiling, and definitely given that the price action is above it, now it turns into support line. It was also aimed for here, provided some support here. Seems valid. I'm keeping it. Okay, let's correct the labels. The 106.80 remains unchanged. That's okay. Now the new R2 is now being placed at 105.40. Let's lock this in. The R1 is now being placed at 103.75, edging a little bit lower. The S1 now it's at 102.35. The S2, which is now being placed at 100.70, sorry. And the S3 at 99.30. Let me check that. Yeah, it's in the clear. We're adjusting. $99.30. Let's reposition the labels so we get a clear picture. That's it. Now we're ready to discuss direction. Definitely the direction for the time being seems to remain in a sideways motion between the 103.75 and the 102.35. The narrowing and the sideways motion of the Bollinger Bands seems to support this idea. And I would also be noting that the RSI indicator, okay, it rose just a bit above the reading of 50, but nothing much is actually right now at 54. So more or less, we tend to maintain our bias for the sideways motion to continue, set in the pre-mentioned levels. I think that the latest price action exactly allowed us to rise it, even the S1 a little bit higher. Note this peak here. That's even better. 102.45. That's it. Should the bulls take over, we may see the price action rising, breaking the 103.75 resistance line, and start aiming for the 105.40, a level which provides resistance here. It's interesting how the level capped the upward movement of the US dollar index. See that some of you guys want to see how the market reacted upon the release of the US CPI rates yesterday. Let me drill out to the minute chart. Unlocking the chart, widening it. This was it. It was a rise at the initial point of 38 pips, ticks, sorry. Yet we also note the consecutive drop in the following 3 minutes of 73 pips. So practically there was an instant market reaction, yes, but overall that did not seem to affect widely the US dollar index. It remained near the same levels it was. Back to the forward chart. Yet it edged a little bit higher over time during today's European session, especially. Seems to be correcting a little bit lower. Everything within a sideways motion between the 103.75 resistance line and the 102.45 support line. Should the bears take over, we would expect the price action to drop considerably. Clearly, we would require breaking of the 102.45 previous low and start aiming for the 170 level, which provides support clearly here. Let's move to Euro USD. Please allow me also to readjust the support and resistance lines. I'm going to be narrowing a little bit the levels. And let's go hunting for a new S3. A little bit off, but I think we have 1-2 touches here which are beautiful. I'm keeping that. Readjusting the chart. The S3 now is being placed at 1.0305. No, 1.0310. The S2 at 1.05. The S1 at 1.0655. The R1, let's have a look, at 1.079. The R2 the R2 could be a little bit lower. Could be placed here. See these peaks here? It was a continuous testing. And that would be the 1.0900, 02, 5. Okay. Let's have a relook at where the R3 is resting. These peaks here. I'm going to be lowering it. And I'm going to be lowering it here. $1.1025. For the time being, we maintain a bias for a sideways motion to continue between the 1.0790 and the 1.0655. The narrowing and the stabilization of the Bollinger Bands seems to be concurring with that idea. Also, the fact that the RSI indicator is practically fluctuating around the reading of 50 implies a rather indecisive market. So we tend to maintain this view. For a bullish outlook, I would require a clear break of the 1.0790 and the price action to start aiming for the 1.0925. Both levels provided the R1 provides resistance here and the R2 resistance here and here. On the flip side, should the bears take over, we may see the price action dropping, breaking the S1, which provides support here, the 1.0655, and start aiming for the 1.05, which provides support here. Let's move to cable. Should be a similar picture. Okay, far wider though. And definitely the low volatility of the past few days does not exactly support such an idea. But nevertheless, I'm going to be correcting this a little bit lower, as I'm going to be neglecting the shadow here. I think the main body of the price action is better described as being moving between these levels. The R2 seems to be quite valid. I'm keeping that. Let's have a look at the R3. Okay, way back, we're talking about May 27th of May last year. But nevertheless, it's the only peak we have here, so I'm keeping that as well. Let's have a look at the support lines. We already mentioned this level. This would be interesting as well. It's pretty valid as well. I'm keeping that. Let's have a look at the S3. Okay, it's resting on a peak. Provides some support here. Seems good. Also provides some resistance support. Seems to be valid. Okay. Let's correct the labels as well. $1.2660 remains. The R2 now is being placed at let's have a look. 23.45, that remains as well. The R1, let's have a look at it. It's now being placed at 1.2215. The S1 is now being placed at 1.1970. The S2 remains at 1.184. And the S3 at 1.1645. That's about it. I would be noting though one element which seems to be of interest. Sorry. It would be this one. The pair seems to be marking higher troughs and higher peaks. So an uptrend seems to be building up. On the other hand, though, for a bullish outlook, we would require clear breaking of the R1, 1.2215. And I would like to see it even higher than this one, this shadow here. The main body of the price action, though, seems to be maintained between the R1, 1.2215 and the 1.1970. Interestingly enough, the intense downward movement, especially during today's European session, drove the RSI indicator below the reading of 50. It's actually at 43. I wouldn't be surprised to see the pair correcting even a bit lower and stabilizing, in which case we may see the price action breaking the aforementioned upward trend line. That would be a first signal, or if you prefer, a verification of the sideways movement. On the other hand, should the bulls take over, I would expect the price action to rise, actually bounce on the upward trend line, rise, break the 1.2215 resistance line, and start aiming for the 1.3345. Definitely a higher peak than this one would be required here. On the other hand, should the bears take over, we would expect once again the price action to drop, break the upward trend line. That would be in the clear. However, for a bearish outlook, I would require also a breaking of the 1.1970 support line and the pair to start aiming for the 1.1840 support level. Let's have a look at USD and JPY. Okay, that's an uptrend. Shifting it to the right. I think this is better. Intense upward movement. breaking the 132.85. Definitely this has to be changed, switched if you prefer into support line. So let's color this in green for starters. Let's go hunting for a new ultimate resistance line. Shouldn't be, here it is. And the next one could be even higher. In red, that would be the 139.90. Okay, these levels, these peaks here seem to be in this show, and this show. Okay, the R2 seems to remain rather tight. The R1 as well. Okay, we're keeping this. We're adjusting the chart. I would be widening the support lines though. I would like to see the support level somewhere here. 1, 2, 1, 2, and this, interesting. And the third support line somewhere here. Okay, let's work the labels. The 139.90 is now the new ultimate resistance line. The second resistance line is being placed at 137.8. The first resistance line is being placed at, let's have a look, 134.75. The first support line at 132.85. The second support line at 130.40. And the third support line at 128.05. Let's talk direction. It seems to be a clear upward movement, an uptrend, and that's being practically supported by three elements. Definitely the first would be the upward trend line. And as long as the upward trend line remains intact, we tend to maintain a bullish outlook. The second element which supports the idea of a bullish outlook is exactly the fact that the move, the 50, the 100 moving average, and the median of the Bollinger Bands 20 are all having an upward slope. And the third element supporting a bullish outlook would be the RSI indicator, which is pretty high right now. It's at 63. So as long as we have mentioned before, as long as the upward trend line remains intact, we maintain our bullish outlook. Should the bulls maintain control, the next possible stop would be the 134.75, given that it has provided resistance here. While even higher, should that be broken, the next possible stop is a little bit wide, a little bit off. It's the 137.80. Nevertheless, it's a level which provided some resistance further back. In case the bears take over, we would expect the price action to drop, break the upward trend line, break definitely the 132.85, and start aiming for the 130.40, a level which provides support here and resistance here, multiple levels and support here. So that seems to be a pretty valid support line. Let's have a look at USD CHF. No recalibration is needed for now. We have a clear sideways motion, maybe with the exception of these breaks here, but the main body of the price action remains between the 0.9275 and the 0.9145. So we expect that sideways motion to be maintained and the range-bound movement to be kept, practically setting these two levels as the upper and lower boundary. Should the bulls take over, we may see the price action rising, breaking the 0.9275 and start aiming for 0.9405. On the flip side, should the bears take over, we would expect the price action to drop, definitely break the 0.9145 and start aiming for 0.9025. Let's have a look at the Aussie, which was weakening during today's early European session. It still does. Okay, there was a wide drop in the Asian session, early European session, and still continues. There is a but here. It's a big but. We're getting some conflicting messages. On the one hand, you have an RSI indicator which has dropped below the reading of 50. It's actually pretty low right now. It's at 39.2, which tends to underscore the bearish intentions of the market. And that's being also supported by the steep drop over the past 12 hours. Yet, as long as the price action remains between the 0.6880 and the 0.7010, we tend to maintain a bias for the sideways motion to continue. So what we're saying here is that we expect the pair to remain in a sideways motion between the pre-mentioned levels, but watch out for any bearish tendencies of the pair. Should the bears take over, we may expect the price action to clearly break the 0.6880 level, which provides support here, and here, and start aiming for 0.6740. On the flip side, should the bulls take over, we may see the price action rising, and in this case, we would require clear break of the 0.7010 resistance line before paving the way for the R2 0.7130, a level which provides resistance beautifully here. Note how it had practically stopped the upward movement. It's as if it hit the ceiling at that point. So seems to be pretty valid. Let's have a look at the USD CAD. Similar wide sideways motion. Yeah, definitely. This is not required. So we have a sideways motion of USD CAD, and that's been ongoing practically since the early days of January. I note here the 6th of January. So over 1.5 months, we're talking about 6 weeks. Maybe one exception would be this break above the R1 at some point in on the 19th of January. But note how the price action quickly reversed lower and once again entered this familiar range. We tend to maintain the bias for sideways motion to continue. Note how the Bollinger Bands have narrowed, implying low volatility is coming. So more or less the 1.3470 and the 1.3285 remain the boundaries of the pair's movement. Should the bulls take over, we would expect the price action to rise break the 1.3470, and thus open the gates for the 1.37. On the flip side, should the bears take over, we may see the price action dropping, breaking the 1.3285, and start aiming for the 1.3095. Once again, sideways motion bias is being maintained, for now at least. Moving now to WTI prices. There was a wide drop during today's European session. Give me a sec. Yep, here it is. But at this point, I would like to drill into the 1 hour chart. Let me allow it to show you. Note how the 1 hour chart exactly marks the hit on the support line and the correction higher. So back to the 4 hour chart. Correcting, repositioning the labels. What I would like to see though is where the R2 and the R3 are resting. Give me a sec. Okay, nice peak here. And here and here. Seems to be pretty valid. Yeah, both of them. Okay, I'm keeping them. For the time being, on the one hand, we have two conflicting elements. We have a clear break of the upward trend line, which tends to imply that sideways motion, a change of trend definitely came in. And sideways motion seems to be in place, especially given that the price action of WTI was unable to clearly break the 78 support line. Note also how the Bollinger Bands are narrowing. On the other hand, though, we have to note here that the price action is constantly testing the S1 and is threatening to break clearly below it. For the time being, as long as the price action remains above the S178, we tend to maintain a bias for the sideways motion to continue. However, should it be able to break below it clearly and start aiming for the 73.60 support level, note how beautifully it provided support here, 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 and here, and here. So it's a pretty valid level. Should the S1 be broken and the price action of WTI starts aiming for the S2, then we would be adopting a bearish outlook. The RSI indicator has been dropping, and that's an indication exactly of how the bulls have relented their effect over the past direction since the 13th of February. It's currently below the reading of 50, just slightly. It's at 45.8. Nothing conclusive yet, but the direction of the RSI indicator is downwards. So overall, the idea here is that we tend to maintain a bias for the sideways motion to continue, but we highlight also the possibility of some bearish tendencies for WTI's price. Let's have a look at your stock markets, making a start with Dow Jones. Note how it has dropped in yesterday's American session and seems to be stabilizing. Overall, though, in my opinion, despite the small test of the 34,400 resistance line, the price action quickly came back below it. And in my opinion, despite the false break here, I would be highlighting that the level held its ground largely, and it verified its role as a resistance line. On the other hand, the S1 was tested or aimed for a number of times, so that's valid as well. The sideways motion seems to be maintained. It's characteristic that the RSI indicator is at the reading of 50. And all of that tends to imply that most probably the outlook remains in sideways motion. Maybe a little bit wide, but still. Let's have a look at NASDAQ. Okay, there was some volatility, which is understandable given the release of the US CPI rates. Let's have a look how Nasdaq reacted at the time of the release. Drilling to the 1 minute chart, let's go further back. We are now entering the 14th of the month, yesterday. Here it is. In a reverse mode than the US dollar, note how the index dropped initially at the minute of the release, however quickly regained its confidence, rose up. It was a movement of around 174 ticks, 175 almost. Once again, some volatility, yes, but overall, the sideways motion, maybe with some slight bullish tendencies, seem to be maintained. Back to the forward chart. So we tend to maintain our bias for the sideways motion to continue, possibly just above the 12,450 support line. For a bearish outlook, which does not be the case for now, but still a possibility and should be covered, we would require clear breaking of the 12,450 and the price action to start aiming for 12,220. That would allow us also to start drawing a downward trend line, showing the possible limitations of the downward motion. Let's have also a quick glance at gold's price. Okay, there's a downward motion here. We can see a bearish downward trend line, slowly but steadily building up. With this exception, this candlestick here, which showed rather indecisiveness rather than anything else, we note that we have 1, 2, 3, 4, 5, 6 candlesticks in the reds. The RSI indicator dropped below the reading of 50. Sorry, below the reading of 30. It's actually right now 24, implying a rather intense bearish sentiment, for gold's price. Yet there is a catch here, and the indicator may be also implying that the price action, the bears may have reached a little bit too far, and gold's price may be ripe for a correction higher as it reaches oversold levels. Nevertheless, should the bears maintain control, I wouldn't be surprised to see the price action dropping, breaking the 1824 support line, thus starting to aim for the 1766. Now it may seem a little bit far-fetched. See this downward movement here. But yes, I would agree that volatility for the time being does not agree, or if you prefer, allow for gold's price to drop as low as this too. But definitely for a bearish outlook, we would require clear breaking of the 1824. That should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
Hello everyone, my name is Emily and welcome to another one of our videos. Today we'll have a look at currency carry trade. A currency carry trade is one of the most famous trading strategies in forex trading. A currency carry trade is when you buy a currency with a high interest currency against a low interest currency. Carry trading involves holding a forex trade when one currency has a higher interest rate than the other currency in the pair. The most famous carry trades involve buying currency pairs like the Australian dollar against the Japanese yen and the New Zealand dollar against the Japanese yen, because these pairs have interest rate spreads that are very high. A trader can make a profit between the difference in the interest rates of two currencies as long as the exchange rate between the currencies does not change. Many professional traders use these currency carry trades because the gains can be very big when they use leverage. However, the bigger the potential gain, the higher the risk. The currency that is exchanged in a currency carry trade transaction is known as the funding currency. A funding currency usually has a low interest rate. Traders borrow the funding currency and take short positions in the asset currency, which has a higher interest rate. The best time to get into a carry trade is when central banks are raising or considering raising interest rates. Also, these trades work well during times of low volatility since traders are willing to take on more risk. As long as the value of the currency doesn't fall, even if it doesn't move much or at all, traders will still be able to get a return. However, a period of interest rate reduction does not provide great gains in carry trades. When rates are falling, demand for currency also tends to fall and selling off the currency becomes difficult. Basically, the carry trade can result in a profit if there is no movement or an increase in interest rates. Hope you found this video useful and interesting. Thank you so much for watching us. Bye-bye.
Good afternoon. Hi, Atur. Hi, Owen. Just want to check that you guys can, before we get started, you can hear me okay? You can see me all right? Let me know, put it into the chat. Sound and screen okay? Fantastic. Seems like everything's okay. We'll give it a couple of minutes before we get started. And while we're waiting, let me know where you're joining me from. And I hope you have had a good trading day, or trading week, or good start to the new year. And a happy new year to everyone as well. Hey Techno, how you doing? Hey Aya. We'll see who else streams in before we get started. Give it a couple of minutes. Today, we're here with IronFX on the webinar series, Mastering Divergence in Trading. Quite a number of things to get through today, so it'll be quite an interesting session. I hope you find it an interesting session and helpful as well. Hi there from Germany. Good to see you. Hey Esther, how are you doing? You know, as we're going to be talking about divergence trading today, let me know if this is a strategy or method that you deploy onto your own trading as well. Do you use divergence? Do you trade with the divergence? I'm very well. I've had a couple of nice trades last night and also this afternoon, so I'm super happy with that. Hey Promise, how are you doing? Fantastic. Good to see. Does anyone attending the session use divergence in their trading? Why I'm asking is just so that I know, how fast or how slowly or how much detail to get into, customize the session a little bit more for you guys. And do let me know. Alrighty, let's get started. So again, welcome to everyone attending the session, and thank you all for attending the session. I know a couple of you have been waiting to join up, so thank you all for attending early and welcome to the session. Today we are here with IronFX on the webinar series, Mastering Divergence in Trading, right? So before we get started, a quick disclaimer is that any information in this webinar should not be construed as investment advice or an investment recommendation, but instead as educational material only. This material is the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. What it means is that I will be sharing with you some ideas, some thoughts, the way to deploy divergence in your trading. What I do usually recommend is that whatever you learn here during this session, I would suggest that first you test it out, right? You read up a little bit more about it, you understand it a little bit better, then test it out on a demo account first, right? Never jump straight into a live trading account with a new strategy or a new method. What you're gonna do is test it out on a demo account. Make sure that you understand how it works. Make sure that you're able to identify the way it works on a demo account. Then you progress on to trade it, I would say, on a smaller trade, right? So size down when you go into a live account, size it down, test it out further. Once you gain that confidence with the method, then you can resume and possibly integrate it with your existing trading strategy. Okay, so these are all, I feel, complements to your trading strategy, not something that I think should overtake whatever you're currently doing. All right, so a quick introduction. My name is Jin Dao. Most of you will know me as Jin. I've been trading for 10 to 15 years now already, so quite a long time. If you do have any trading related questions, please feel free to reach out, let me know. I'll be happy to address your questions as they come up. Okay, so today we're talking about divergence when we are in trading, right? Using different price levels and also the tools and indicators to help us to identify possible divergence. All right. Good to go. Any questions at this point? I do see that a couple of you are new to trading. So what I would suggest is that, this might be something that you want to look further into. It is a very powerful and quite commonly used method that a lot of traders monitor and deploy with their trading. So I think this might be a good starting point, right? And it's relatively simple to understand, relatively simple to analyze and to deploy. So it might be something that you might want to look into a little bit deeper as we progress through this session. So with that, let's get going. Couple of things to get through today. First off, obviously, what is divergence in trading, right? What is divergence in trading? And, as the word, let me just get that up. As the word suggests, divergence, right? Just plainly explained, in divergence means one thing is going towards upside and then something else is going in opposite direction, right? Obviously, everything is moving towards the right, but one is moving higher and then something else is moving lower. Or in the flip side, I should change the color. Let me just do that. All right. On the flip side, one goes down and then the two goes up. That's a terrible color. Sorry about that. Okay, so first off, what is divergence in trading? That's when we actually see price moving. So I always say that top level here is price. Price moving in a different direction to what the indicator is telling you. I can't scribble with the mouse, but what the indicator is telling you. So very commonly, most often, we always see price moving in the up towards the upside, and then we see the indicator pointing towards the upside. So this is the common view, is that we see price pushing higher while the indicator, for example, the RSI, is pushing towards the upside as well. So that's what we saw. We say a confluence, we would say it's moving in alignment, right? Indicator pointing in the same direction as price. When it comes to divergence, it's when price moves up, but we actually see the indicator pointing towards the downside or moving lower. What indicators can you use to identify a divergence? First off will be price at the top, but in terms of indicators, we can use the stochastic, right? We can use the stochastics, we can use the RSI, or we can even use the MACD, the moving average, convergence, and divergence. Quite commonly, the question I'll get when I come to this point is that, people will be asking, so which is better? Should I, is the stochastic better than the RSI, or is the RSI better than the MACD, just based on the sequence that we're sharing? There's no better indicator to use. It all performs in a similar fashion, right? All performs in a similar fashion. But what it should actually tell you a similar story, identifying that similar setup for you. So it really doesn't matter whether you use the stochastic, the RSI, or the MACD. Sorry about that. I'm still coughing terribly, so just bear with me there. Okay, so different indicators still would tell you a similar story. Then after that, on point 3 here, so this is 2, and this was 1. On point 3 here, we have different types of divergence. Different types of divergence. There are normal divergence, there are hidden divergence, and the exaggerated divergence. Now, put it into the chat. What do you think is going to give you a bigger possible potential move when you identify divergence? Normal, hidden, or exaggerated? What do you think is going to give you a bigger price movement? Normal, hidden, or exaggerated? Okay, right? Yes. So good stuff there, right? It exaggerated tends to give you, or would tend to give you, a bit more of a potentially bigger price movement. But there are other things to consider, not just the types of divergence. And then with that, when we understand how to use the indicator, how to identify the different divergence, we'll combine them all together to look for our trade setups. Okay, so quite a number of things to get through today. At any point, if you do have questions, please feel free to put into the chat, let me know. And also, if time permits, what I'll do is at the end of the session, I'll jump into a live charts and try and identify some divergence or live occurring divergence for you guys. Sounds good? Alrighty. So first off, jumping ahead a little bit, the different types of divergence. Like I was telling you, okay? So I remember that on the top, splitting this, on the top is price, on the bottom is indicator. So there's the blue line and the red line. That's the regular divergence. The hidden divergence, again, price and indicator. And then the exaggerated divergence in terms of price and indicator. Okay, so how do you identify a divergence? Right, let's look at the regular divergence first. How do you identify a regular divergence? We split the divergence up into a bearish divergence or a bullish divergence. As the name describes, if we have a bearish divergence, what we anticipate is for price to drop strongly. If we have a bullish divergence, then we anticipate that price should climb higher. So things to pay attention to is the turning points on price, right? So we're looking for price to move up, turn back down, move up again, turn back down. So we have a higher high, and then another higher high. So when you have higher highs, you say that that's the first part one, okay, just as what we have here. And then you look at the indicators, right? For example, in this case, let's say the RSI, and you're looking for it to form a lower low. So in this case, as the indicators might go down this way, bounce back up, turn back down, and then turn this way, you say this is a low and a lower low, right? So you say that we have a divergence, a bearish divergence, price forming higher highs, or the peaks of price forming higher highs, and the indicators forming lower lows. All right, so with that, we will anticipate that price would retrace or correct towards the downside. Remember, the things to remember here is that when you're looking at bearish divergence, you're almost somewhat identifying a upward trend line, right? Or a trend line that's resisting, providing that resistance to price, right? So it's hit the price resistance once, twice, and then a big retracement towards the downside. In terms of a bullish divergence, you're looking for a lower low in terms of price, a lower low in terms of price, and when price goes this way, no, let me do that again. All right, so when price goes this way and then this way, so now we have that trend line towards the downside, and then we have a higher low, right? This will be a lower high. Pardon me, this will be a lower high. Then we have that divergence towards the upside. So they will call this a bullish divergence. Okay, so I'll take that away. I think the regular divergence is relatively straightforward in terms of identifying it, because we're looking for that higher highs and the lower highs in terms of the bearish, and the lower lows and the higher lows in terms of the bullish divergence. What happens with the hidden divergence? What happens if the hidden divergence is when you actually see price moving lower? So you have in this case, a high, and then we have a lower high, while we have the indicator actually giving us that, a high, and then a higher high. All right, so it looks like it's pointing towards, it looks like those lines will be converging, pointing towards the same meeting point. That's what we'll have, the hidden divergence, a bearish hidden divergence. And then when we look at the bullish divergence, it actually separates out, it points further apart. You can see here it's formed by a low and then a higher low, right? A low and then a higher low, while the indicator will be formed with a low and then a lower low, where you would have the divergence pointing in separate directions, one pointing towards the upside, one pointing towards the downside. That would say a bearish, or rather a bullish hidden divergence. And then lastly, the exaggerated divergence. That one is relatively straightforward to identify, because we're looking at price not forming that diagonal move, right? We're not looking at a higher high or lower high in what we had on the regular or the hidden divergence. What we're looking for in the exaggerated divergence, whether it's bullish or bearish, we're actually looking at price trading or forming a good strong horizontal resistance or horizontal support level. Okay, so you can see here where we have here at this point, price testing, before testing again, horizontal level, right? A horizontal resistance, not looking for the higher highs or higher lows, and then but the indicator forming a high and then a lower high, right? So you have price resisted to move towards the upside, but yet you have the indicator pointing towards the downside or trending lower. That's why we say we have the exaggerated divergence on a bearish note. And then on a bullish note, we'll have it forming a support level, right? At a support level, while the indicator is forming a low and then a higher low, indicating further upside or indicating that bullish potential. All right, so quite a number of things to take note of in terms of identifying or understanding the different types of divergence. While this session is being recorded, what I will also suggest to you guys will be to take a quick snapshot or do a quick scribble in terms of the the 6 different divergence: the bullish, the bearish divergence, for the regular, for the hidden, and also for the exaggerated divergence, right? So this, you can use it as a quick reference guide. Okay, so if you have already, great. If not, let me know. I'll come back to this slide again. So looking at it in terms of on a chart, it's fine. It's relatively easy to identify it when we're looking at it with lines purposely drawn to identify the divergence. But how does it look like on a chart? We have the examples here. You can see that firstly, price is testing a resistance level, right? It's formed. It's almost, if I can draw a horizontal line, you can see it's formed right across. right? Forming a little bit of a smaller high, resulting in a bearish divergence with RSI. So it's tested a bit across, but you can see that in this case, it's moved up a little bit, right? So we're talking about small movements. It can also sometimes be quite obvious, right? Sometimes it's quite hard to identify a divergence or bearish or bullish divergence, but sometimes it's going to be quite obvious. In this case, as a first example, almost horizontal, almost like an exaggerated divergence, but we also would say that it's a bearish divergence here. And then you can see RSI first at this point, and then trending lower, right? So this is a little bit more obvious. You can see it pointing towards the downside. So we either have it going up like that slightly, potentially, and then after that, the RSI forming that. Oops, I'll draw that better. And then the RSI forming that move lower again, right? So we're looking at that. And then if I scroll back, you can see that for this to point up and this to point, the indicators trend to point down, right? Pointing up and pointing down, or moving right across and pointing down. So this would tick the examples of either a regular divergence or the exaggerated divergence, which still would give us the indication that we're looking at a potential bearish move towards the downside. Okay, so you can see here, price moving across, right across, or slightly towards the upside, and then the RSI here moving slightly lower, right? So we see that divergence, that bearish divergence. And what happens? You see that price traded strongly lower, right? Strongly lower, not just because of the divergence, right? Price reverses strongly from that horizontal resistance level. It also traded lower because the RSI traded down, right? From the overbought region to the almost towards the oversold region, and also because of that bearish divergence. So what I'd like to do, right, as much as we're talking about the divergence here, right, as much as we're talking about the divergence here, I wouldn't recommend, entering a trade just because of a divergence. I wouldn't do it just because of a divergence, right? I'll still be looking at, yes, I'll identify a divergence, but before that, I'm looking at support and resistance levels, right? You can see price resisting that resistance level. You could also be looking at the previous trend. And also you'll be looking at indicators just giving you that signal of where price could be heading towards. Putting all that together, then after that, identifying a divergence gives you that confidence, right? Gives you that confidence because you get a confluence of analysis. You get many things put together, giving you the same signal, telling you that we're potentially looking at some downside. And that's why we see price having moved strongly lower. All right, at this point, any questions? Any questions at this point? Let me know. Or if it's all good, clear and good, let me know as well. And we'll move on. Alrighty. Okay, so with that, thank you, Esther. With that, we look at again another one, right? An idea of a repeated divergence. So now let me ask you, if you see a divergence and it trades well, and what happens? What do you think will happen if you see multiple divergence? If you see it happening over several times, most likely going to give you a stronger signal, right? A repeat of what could happen. So in this case, quite straightforward. You can see that price pushing higher, right? Moving towards upside. That, oops, I'm terrible with this drawing. right? You can see price forming a higher high. You can see price having a high there and then forming a higher high. But yet we see the stochastics. In this case, in this example, we're looking at stochastics forming a lower high, right? So this was the high point here, and then it's formed a lower high. So it's pushing towards the downside. Again, as price pushes up and the indicator, in this case, the stochastic pushes down, what we would have is a bearish divergence. And you'll see that if I can just draw a straight line across, that was the previous resistance level, right? We saw a little bit of a break towards the upside. And then because of that bearish divergence, we saw price come strongly towards the downside. Okay, so this is also one good way or another tool to help you identify potentially some false breakouts. I always get questions from individuals that I coach in terms of how do you identify a potential false breakout. You could use divergence as price breaks out of a resistance level. You see a divergence form, you anticipate that price could trade back down again. In this case, you can see as the divergence forms, we see price trade lower. All right. So what is a repeated divergence? You see again, if I take that away. Okay, if I take that away, you'd see that now we have that high and that forming slightly lower. Again, a slightly lower high on the stochastics. Right? No, they're here. Okay, high there. One formed, and then after that, this formed here. But yet, price is moving towards the upside. Again, another bearish divergence. I was just sharing with you before, just as I was drawing that, why this wouldn't work is because as much as we see this moving a little bit across, a little bit towards the downside, we haven't seen price, or price rather has been trading right across. It hasn't really turned towards the upside. We haven't seen a higher high, right? Or we haven't seen it turn down from that resistance level. So it hasn't really formed a divergence yet from this picture, right? So we have one divergence formed here. And then as price goes up, you'd say that there's another divergence as we see this push higher while the stochastic pushes towards the downside. Okay. And what's very interesting here at this point is also to identify that this is a bit of a resistance level formed on the stochastics, right? It's also a resistance formed on the stochastic where you see that it's hit that level here and turn back down, again hit that level and turn back down, which could be also considered as a hidden resistance level. Why is it hidden? Because we normally draw the resistance level on the price charts, not on the indicator chart. All right. So with this repeated pattern at this point, well, what could you anticipate? We'd say that we anticipate for price to turn down because of that bearish divergence. And that's where you see price shooting towards the downside as that bearish divergence forms, as it retraces or breaks out from that upward move. Okay, so we've gone through just a couple of divergence at this point. Firstly, the normal divergence, right? Just a quick introduction of the normal divergence, and then also the repeated divergence where you see where you see it happening once and a relatively small move towards the downside. But then after that, when you see it happen twice, a repeated pattern, you see a bigger move tracking lower, right? A bigger move towards the downside on the bearish divergence, because it's already happened once, small move, and it happened again, we see that big move down. Okay. So with the divergence, as we were looking at it, you have that high, that higher high. So this was a high point. This is a higher high. And then also when you have the stochastics or the RSI or the MACD giving you that lower high. I'm just trying to draw it properly. High point and then that lower high point, right? So when you have that pointing down and then that pointing towards the upside, we can pretty much identify where is an entry point. Whereas an entry point is when the turning points align. Right? I didn't draw it exactly. I was just trying to struggle to draw it a bit. But when the turning points align. So in this case, you can see at that dotted line, I would say as the candle closes, just to ensure that you see that downward move or that pivot level, you'd say that that would be your entry level, right? Your entry level. Then the common question comes is, wait, so if I know that at this point, that's my entry to sell, right? The entry to, let me just do that again. It's terrible to try and write with a mouse. Right? That's where you would be looking to sell. Then what happens is the next question comes with, okay, great, Jin. If I'm looking to sell at this point, where's my take profit going to be? All right, where's my take profit going to be? This case here, where the divergence started. It could very well go a lot lower than that point, but you'd say that your first target could be at your take profit would be here. That'd be your first take profit level. You might be looking to close out half the trade at that point, right? What I would suggest is you could be looking at closing out half the trade, right? Or you could be looking at moving your stop loss to break even when price comes to that point. Or, well, you could be looking at closing out the trade completely with your take profit. Okay, so you say that if I'm looking to sell at the formation of that divergence, my first decision point will be at the take profit level where the divergence started. My stop loss, I would say, would be above that previous high as your stop loss level. Okay, so relatively tight. You tend to have relatively tight stop loss when you're looking at divergence, when you're looking to trade divergence. That's why I suggested at the start that this might be quite a good starting point for a lot of new traders, right? You have a relatively tight stop loss, and then your take profit. If you're not so risk seeking, you could be looking to close out exactly where it started, or you could be looking to close out half the trade or any amount of trade, or you could be looking to move your stop loss down to the break even level just to protect the trade and see how far down it can go. Okay. So in this case, you see that as we spotted that divergence, right? We were looking to sell at this point here. Our stop loss would be above, either above that previous high or above that divergence. I would say about that point. And then your take profit would be at this level here. Okay, you see it come down, come close, bounce back up, and then after that, complete that reversal to hit your take profit level where it first started, where that first divergence started. Okay, in fact, here's another divergence that you could have entered on the shorter term. All right, and we say this would be the exaggerated version of a divergence. You can see that price moving right across, right? So a horizontal movement or horizontal resistance on price. And yet we also at that point see the RSI in this case forming a high and then a lower high. So with that, if I can draw a straight line down, almost did it, right? As that forms, you see that price shot towards the downside with that divergence forming as well, right? So it's not just that big move that you have identified. You know, you can identify other potential divergence within one move, right? So you could have one trade. I would say this would be your first trade. And then as price comes down, bounces back up, you form another divergence, and then this will be your second trade towards the downside. This would be number 2. Okay, so in one move, over a medium long period of time, you could have multiple divergence being formed. I didn't see that question there. I didn't see anyone raise that question. When, so commonly what the question I'll get is when, in terms of time frame, can you use or can you look to identify a divergence? So this can be done, or divergence can be identified on any time frame. Okay, you could be looking at it on the daily time frame. Oops, not the P, it's a D. Right, so you could be looking at it on a daily time frame. You can looking at it on the H4. You could be looking at it on the H1 even. Right, but as much as it'll work across everything, I would say that M15 might be the lowest that you go down towards. Right? I wouldn't actually look at anything lower than that, because what happens is that anything lower than H1 tends to get a little bit noisy. You see price fluctuating around with quite significant or choppy price movements. So if you try and identify it on too small a time frame, what you might actually get is possibly a lot of divergence in terms of occurrence of a divergence, but it might not all play out very well. Okay, so I would say that if you really have to, or if you should keep it to the daily, the H4 or the H1 time frame. And if you really, really have to, with nothing else to do, then you might consider the M15 at the very lowest. I wouldn't trade it any lower than that, any lower time frame than that. Fair enough? Good stuff. Okay, so with that, right, we'll be looking at forecasting. Right, forecasting. We put it all together. We try and identify where price could be heading or has been heading, and then how it could turn with a divergence. In this case, you see that the RSI broke the trend line or broke the supporting line before price did. Right, you see that moved down, but yet you identify this. Okay, you identify a lower high, and then here forming in this case, a higher high, right? A higher high. So straight away, we can see that a bearish divergence is formed. In this case, using the RSI, a bearish divergence is formed. Price broke the RSI broke the ascending support, indicating that price might trade significantly lower. Then after that, we look into price breaking out the ascending support line, right? Showing again, similar to what we identified on the bearish divergence, because at that point, we're anticipating for price to move lower. We're looking for that big downward move. Okay, so you're actually combining a few analysis together. Not just, remember, it's not just the divergence. You're looking at trend. You're looking at support, resistance. You're looking at the indicator itself. All that add together with the divergence. Sorry for the scribble. What it ends up with is we're going to see a higher probability trade setup for a potentially big move towards the downside, right? And you see that big push as it not only has a divergence, but it breaks the trend line as well. Fair enough? All good so far? Okay. Similar thing here. You see that price has been resisted by that trend line, right? Price has been resisted by that trend line as it trades lower, right? As it trades lower, first thing, how do you like get ready or get preempted to look for potential divergence is when you see the indicator giving you that early signal, right? You see that trend line towards the downside again on the RSI here. And then the indicator, and it gets resisted here, looks to break out. Looks to break out of that trend line, of that downward trend line. With that, you'll be going, okay, great. It's looking like, or the indicator is indicating the potential for some upside. From there, you'll be looking at, can I identify any potential divergence? So in this case, you see price forming a lower low, right? Price forming a lower low, but the indicator forming a higher low. So what happens when you have a lower low in terms of price and a higher low in terms of the indicator? We're going to have a bullish divergence, right? It forms up with a bullish divergence. And as the RSI breaks above that trend line, we're going to see that potential for the upward move. Even as that divergence is formed, let me just do that straight line again to the best I can. Right, even as that divergence is formed, we already see price moving higher. We already see price moving higher. So that's your first move. Sometimes you will not be able to catch that move straight away. You might not be looking at the charts during that time. You will see a divergence or bullish divergence formed. You might have missed that first move, but as price looks to break out of that trend line, break above that trend line, you can also see that if it breaks above that trend line, I have a bullish divergence supporting this analysis for that potential move or big move towards the upside. And then you can see that as it breaks out, we see not a steep move, but we can see price trading higher along with that bullish divergence and that trend line. Okay, so this is another way to add on, all right, add on to not just a plain divergence. You'll also be looking at adding the trend line to it just to help you identify a potentially bigger move as well. Okay, so sometimes as I teach a lot of traders how to use a divergence, they might not spot it right at that point because you're not watching the charts. But if you identify a divergence after it's happened, you could also be looking for additional information as it breaks above a trend line or a resistance level. You're going to see a potentially bigger move towards the upside or the downside. Any questions so far? All right, we've come to the end of the slides. So I just want to check if you've got any questions so far. Just let me know. I'll give you a couple of moments to check, to type it up if you've got any questions. Okay. This is recorded. I think you can possibly head to the YouTube channel. I'm pretty sure it will be uploaded there. If not, you can probably reach out to one of the guys fantastic guys at IronFX. I'm sure they will be able to get you a version or recording of this session. All right. Oops, let me move that away. Okay, so like we were talking about, okay, so we're going to try and identify a couple of potentially divergence levels. Okay, so what you want to look for in terms of a bearish or bullish divergence. Let's look for a bearish divergence. This is on the, let's do on the H4 time frame. The hidden divergence is just when you have price. Let me just try and draw that out. Okay, so a bearish divergence is when it points, price does that. Okay, and then the indicator points this way. Okay, so you have a not the best drawn, but a lower high, lower high, and then you have a higher high on the price. For a hidden divergence is when it points in this direction. When price has a lower high, but yet the indicator is forming a higher high. Okay, so you're comparing these two together. Right, so it's just pointing in different directions. Both of them are bearish divergence. Both of these are bearish divergence, but you just have price pointing in a different direction compared to the indicator. Does that answer your question there, Promise? Fantastic. Good stuff. Okay, so let me try and do this. Let's see if we can identify a couple of divergence. Tricky to do it on the spot straight away, so just bear with me for now. We could actually be looking at no, that doesn't form. Okay, so things to watch out for when you're trying to do a divergence. You can see that price in this case trading, forming a lower high, right? Forming a lower high in this case. And then after that, so you would think that maybe I have a hidden divergence here, but you say that on the RSI, you know, this is also forming a lower high. So it doesn't work in this case. You know, you don't want to try and force the analysis. We do have, nope, not here. Might have something here. A lower high formed, and then not the best. It does get tricky when you try and find something on the spot. Okay, let me just try and find another different chart, something that moves a little bit more steadily. Just wanted to make sure that I try and give you guys an example. All right, do we have something here? Okay. So we have price forming a higher high. Okay, so this is how we're looking at it. Price forming a higher high. And then after that, the indicator forming a, oh, don't have it there. It's supposed to turn to be down this way, so it didn't form. Well, I was hoping to identify that. Okay, let's try this one. Price forming a downward move, and that's pointing towards the downside as well. I just want to find something this way. Nope, it's all following the same direction. Trying to H1 time frame. We might have something here. Okay, so in this case, we have price forming a higher high, while we have the RSI forming a lower high. Okay, you can see that price forming a higher high where we see it going this way, while we have the indicator forming a lower high where price goes down this way. All right, so that is what we call a bearish divergence, a regular bearish divergence, and that's why we can actually see that as the price, as the divergence forms, right? Even slightly before that, as divergence forms, you know, we can see price trading significantly lower. And even this case, you can even say that it's formed right across, but I think that it's more accurate when you say it's at that point. All right, I'm glad I found at least one example for you guys. Let's see if we can find another one. So a higher high here, higher high here in terms of price on the, and then after that, the indicator forming a lower high. Okay, so there you have it. Another example here. Oops, as price forms a higher high and the indicator forming a lower high, again, another bearish divergence formed on the US yen on H1 time frame. All right, does that make sense? It's hard to try and find it, so I wouldn't suggest trying to sit there and look for the divergence specifically, right? I would say that how I deploy or how I use the divergence is that when I identify a trade and then I somewhat identify a divergence, it supports the analysis that I was doing. It supports my view that, or my previous view and my previous strategy as well. Okay, so don't go sitting there trying to spot only divergence. It's going to be a rather futile effort. I would say that it'd be better to try and look for that moves instead. Okay, so we can also see here price pretty much trading right across, right? Price trading right across, but yet in that same period, we actually see the indicator pointing, or the RSI pointing towards upside. What we have here is the exaggerated bullish divergence. You see that at that point, right, as that's formed, price pushing strongly upwards. Okay, exaggerated bullish divergence is when you see price testing the same level right across, while the indicator forms a lower or higher low. All right, does that make sense to you all? As we come to the end of the session, I hope you found the information useful and interesting and useful. Thank you, promise. And if you do deploy this onto your trading strategy, please make sure you test it out first, build that understanding, build that confidence level, first on a demo account, then on a couple of small trades before you start trading, and complementing it together with your own trading strategy. With that said, I wish you all good trading ahead. Remember, trade well, trade safe, and I'll catch you again. Take care now. Bye-bye.
Session today, we want to continue with trading insights about silver and look at what affects the price of the precious metal. Silver prices are not easily influenced or affected by political or economic events. This is because it is viewed as having an inherent value, meaning that its value is protected against times of financial stress or political instability. When compared with gold, the price of silver tends to be much more volatile, while a much higher proportion is used in industry than the yellow metal. The price of silver is dependent on supply and demand. In terms of supply, silver has the largest volume compared with other precious metals. Meanwhile, the mining of silver has substantially increased over the past few years and is often a co-product of either mined minerals, such as gold and copper. Due to its wide use in industrial fabrication in products such as conductors, switches and fuses, silver prices can be affected by industrial output levels in terms of production volume. The price of silver tends to follow the price of gold. Although this is not set rule or formula, there is some evidence that a price correlation exists between the two precious metals. As the world's leading currency, the US dollar has an impact on the price of silver. The price direction of the dollar has an inverse effect on silver, meaning that the precious metal can be an appealing investment when the dollar is low. Thank you for watching. This third part completes our series on trading silver. Stay tuned for more exciting educational videos.